Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So a couple of videos ago I said we will be looking at undervalued stocks in both the growth side of it and the dividends. So today we will be looking at 5 different companies in the growth side of things. Okay, so these are companies that not necessarily dividend paying companies. But one thing I'm actually interested in is I want to make sure the companies that we talk about today are companies that have earnings. Okay, so we're not talking about companies that are still like losing money, because right now those companies are actually not doing well at all. Okay, so we want to make sure these companies have some sort of free cash flow. These companies do have a earnings side of things, and that's what we're going to do. But before we do that, I just want to say thank you to every single one of you guys who have subscribed to the channel. We've got now over 2,100 people who subscribe to the channel. Anyone that watches any of the videos, okay, I really appreciate it, and liking the videos and sharing with your family and friends. The reason I started, like I said before, was just to kind of inspire other brothers and sisters out there, to show them you can invest in the stock market in a halal way. Okay, and that's really important. So I appreciate every single one of you. Thank you for supporting the channel. Let's now get started on basically the video. I want to make it quick and short and nice, this one. All right, so we got the ticker, the company, the moat. The moat is very important to me, because this is, if a company has a wide moat, that means they have a competitive advantage over their competitors. There are different things we look for when it comes to moat, okay? But the most important thing for me is that it has a wide economic moat, okay? Then the current price, then the current PE, the forward PE. In fact, this is not current PE, it should be EPS, okay? So that I'm going to change that to EPS, okay? Earnings per share. Then forward PE, profit margin, operating margins, return on equity, current ratio. We're looking for current ratio above 1, because that tells us that if the company has enough cash to actually pay off their debt for the next 12 months. Then we're looking at free cash flow, the 10-year return. We're looking at the growth in the next 5 years, and then Morningstar valuations. Okay, so the first company we're looking at today is in the cybersecurity company. There's Fortinet. It has a wide economic moat. It's currently trading under $49 per share. It has a positive earnings, which is very important. Okay, they have a forward PE of 42, profit margin of 18, operating margins of 22, and return on equity is not there yet. Current ratio is above 1, which is good, and they do have a free cash flow of $1.17 billion, which is important. Total return in the last 10 years, we're looking at about 28%. And the next 5 years, they're expecting the earnings to grow about 23%. It's discounted right now about 30, almost 40%. The price should be about $68 per share. So this company, okay, is in terms of market cap, we're looking at about $38 billion. So it's basically not a huge company. According to Seeking Alpha, the ratings for Seeking Alpha authors, they're saying it's a buy. Wall Street is also saying a buy, but Quant, which is the basically software this company has in Seeking Alpha, is giving about 3.36, which is closer to a buy, but for them it's a hold at the moment. One of the things that I actually like about this business is the fact that their basically revenue is growing year after year. So since 2017, they have been increasing their revenue every single year, and they are expected, so up to here 2021, so 2022 they haven't reported that yet. They're expecting about $4.43 billion in revenue, and then the year after $5.37 billion. In terms of earnings is also same story. I'll say, okay, so the blue is the actual, okay, and then if you take that out, you will see the blue basically is increased. 2022 is actually come down a bit. This way we're looking at quarterly, but if you look at it annually, you see different. Okay, so remember, quarterly sometimes it can come down, can go up, but what you're interested is the annually. Is that increasing? And it's definitely increasing, ahead in the right directions. Okay, the final thing I want to show you about this company is the outstanding shares. So they've basically increased it a couple of years, and then they are buying back now, which is good sign. The fact that they have a free cash flow and buying back their own shares, that is a very good news for investors. And like I said, they deal with a lot of cybersecurity side of things, so they have a lot of solutions for that side of things, right? Right, so that's the first company. The second company is AMD. This company does not need an introduction. It's been around for donkey years. Is now taken over from Intel, which is, by the way, Intel has now became basically non-Sharia compliant because the debt level is quite high. It has a narrow economic mode, $64 per share, and they have an EPS, which is actually surprisingly low. I thought it would be in $5 plus kind of thing, right? But it is quite low, 1.67. In the end of the day, at least it's a positive, right? Forward PE is very, very cheap, 18.52. Profit margin 10, operating margins 11, return on equity 5%. Current ratio, we're looking at over 2, so they've got enough money, $3.41 billion of free cash flow, and return in the last 10 years, we're looking at about 39%. This is why a lot of people love this company, because of that return in the last 10 years. And the next 5 years, they're expecting about at least a 15% growth, and it's 77% discounted right now. $115 per share is where the price should be. So in terms of ratings, let's have a look at what Morningstar not seeking alpha is saying, especially Wall Street. So Wall Street is actually saying is a buy, and the price target is actually at least $89 per share, and here we're looking at 115, so it's slightly basically cheaper. 38% basically they're saying upside if you were to buy this stock right now. Now, one of the things I'm going to show you quickly is the earnings. So it's in terms of revenue side of things. So you can see the revenue is increasing every single year, and next year is actually from 16.4 to next year $23.53 billion. So that's a massive jump. And then the following year 25.23. So it's slightly a decline. Is it a decline? No, it is going up to by about $2 billion. Okay. Right, so the next one, that's just the revenue. And then when we look at the annualized earnings per share, you can see if we just click actual, so the basically what has happened, okay, this is the estimate. So they beat the estimate every single time, but what we're interested is from what is the earnings been from 0.13 cents basically to right now 2. So this was wrong. Okay, maybe it was wrong. Okay, but anyway, it's $2.79. Basically, that's where it is. Okay, and like I said, I mean, this is a great company, but one thing that worries me about this business is this bit here. Shares outstanding has been increasing for year after year in the last 10. Since 2012, it has increased every single year, which is basically because it's a growth company. Sometimes I don't mind that, because I rather them basically issue more shares if they buy in other companies, if they, and they did buy another company. I think it was a Chinese company not long ago, and about a year, 2 years ago. So again, it's still diluting, but they do have some free cash flow. So hopefully they will stop diluting the outstanding shares in the next couple of years. Right, so the next company we're looking at is ServiceNow, which is very similar in terms of business-wise. Is very similar to Salesforce. Okay, they deal with a lot of HR side of things. A lot of software development companies use this. Okay, it has wide economic moat, $388 per share right now. It has a positive EPS. Forward PE is quite expensive, 52 right now. Profit margin and operating margins and return on equity is non-existent almost, okay, because it's still on the growth side of things. Current ratio above 1, which is fine. 1.8, let's call it $1.9 billion in the bank right now. Total return in the last 10 years, we're looking at about 29%. Growth estimate next 5 years is expected the earnings to grow about 26%. It's discounted right now 64%. $640 per share is where the price should be. Right, so when we look at the ratings, if we look at Wall Street, okay, we are basically seeing $527 per share is what they expected the average price to be. About 35%, 36% upside from where it is right now. And then when we look at in terms of revenue growth in the last couple of years, and like I said, by the way, it provides enterprise cloud computing solutions, defines structures, consolidates, manages, and automates services for enterprise worldwide. So a lot of companies actually use this, just like Salesforce. And as you can see, the revenue is actually beautifully growing every single year, year after year, right? One of the things that I want to show you, again, looking at the annualized and looking at the actual, okay, you can see the EPS is also growing. And again, this is another company that is still diluting shares of basically, these companies are very well known for doing these things, okay? Mature companies now buy back their own shares, but with these companies that are still in the growth phase side of things, they do basically dilute your shares. And this is one of the companies that are still basically doing the same thing. Right, so the fourth company we're looking at today is MasterCard. MasterCard is actually, to me, is a growth company, okay? It has been around for a long time, but it's still growing 21% almost every single year in the next 5 years, which is quite high. So we're currently trading, it has a wide economic mode, currently trading $347 per share, $10 of EPS, which is amazing. Forward PE, trust me, this is actually low for this company, right? Profit margin of 32. Normally you're looking about, I've seen it when it was 50s, okay? Right now it's come down quite a bit. 44% profit margin, 55 operating margins, and 145 return on equity. Current ratio is above $110 billion in the bank. They do pay dividends as well, very small, but I haven't included that in here. Total return, we're looking at about 22%. Growth next 5 years, like I said early, 21%. Fairly valued right now, $369 per share. So if we go back and basically type MA, okay, MasterCard, we will see in terms of their ratings, okay, especially for Wall Street, it is actually a buy, and their price target is about 14% upside from where it is right now. In terms of revenue, if we go back here, you will see it's actually growing and heading in the right directions. Okay, 2020 was a decline because of probably COVID, and then it went back up again, and they are expecting to grow that in the next 2 years. And then EPS exactly the same. If we do the same thing again, you can see it has grown, but 2020 was declined. 2022 is up. When they report, okay, their final earnings, I think they will be reporting soon. If we go to earnings, and the latest, so January the 26th, when they report, that will be Q4, then we will have a lot more information about this company. In terms of shares outstanding, this is what you want to see, okay? And this is the difference between a growth company that's still growing and needs the money to reinvest in the business than a company who's actually got $10 billion in the bank, right, and still growing. So this company is buying back their own shares, and they paying you a dividends, and the total sales is actually heading the right directions. So that's this is what you want to see. You want to see this one declining and this one going up, and which is what is happening to this company. Is absolutely beautiful. Right, so the final company we're going to talk about today is Autodesk. This company provides a lot of 3D designs and so on. Currently, they have a wide economic mode, so they do develop a lot of different types of software, including 3D software. And it has wide economic mode, $168 per share. They have actually a positive EPS of $2.84, and forward PE is 28, which is not actually bad. It's quite low for this company. 12.6 profit margin, operating percent of profit margin, operating margins of 17%, return on equity 78%. So their current ratio is actually slightly lower than one, which tells us basically in the next 12 months the company might struggle, okay, might not have enough assets to pay off, that they can liquidate to pay off in basically any debt that they have, okay. Debt obligations in the next 12 months might be a bit of a struggle, but the fact that they've got $1.84 billion in the bank, that could potentially help the company. Total return in the last 10 years, we're looking at about 18%. Next 10 years, 5 years, they expected to grow at least 20%. Discounted right now, 23%. $230 per share is where the price should be. So like I said, this company, what does it do? Provides 3D designs, engineering, and entertainment software and services worldwide. Okay, so they have all types of software. As you can see, the revenue is actually growing in the right directions, and the overall EPS is also growing in the right direction. Right, so let's have a look at the analyst and what they think about this business in terms of the Wall Street side of things. And as you can see, it's about 22%, and what did I say here? About 23. So more or less they kind of agree. $229 per share basically is what they say in the price should be. And there you have it. So 5 different companies all have a positive earnings, free cash flow, and they're growing 15% or more basically in every single year in the next 5 years. And that's what you want to see. You want to be safe. The company has some sort of earnings. They do have cash in hand if they need to. Their total return basically in the past actually was good. The past does not tell us what might happen in the future, but it kind of gives us an idea of where we're heading, right? So, and the fact that the future looks okay for a majority of these companies, and 15% or more, that's even 10% is really good for these companies. And the fact that majority of them are right now discounted is good. Now, I'll be honest with you, I don't own any of these companies right now in my portfolio. The one I'm interested in possibly adding to the family portfolio, okay, is MasterCard. I already have Visa in my own portfolio, so MasterCard seems interesting. If the markets come down in the next couple of weeks or months, I might start looking into this company. I do like AMD. I do like basically what they're doing in terms of the chips and so on, but I don't know if I have got the guts to actually buy this company again. But we will see. That's just me me being transparent and so on. If you like this type of content, please like the video, subscribe to the channel. Let me know if you have any questions. Like I've always said to you guys, I'm just trying to help the community and bring you companies that you could potentially look at. If you're interested, say for example MasterCard, go into their website and find out everything they do. A lot of you probably think MasterCard is not Sharia compliant, but they are Sharia compliant actually. And in fact, that's the final thing I want to show you, is the fact that every single one of these companies have absolutely no problem when it comes to being a Sharia compliant side of it. And one thing I love about them is the fact that their interest-bearing debt and interest-bearing securities for these high growth companies is very, very low. Always is. The mature companies is the ones that you really need to worry about, but these companies are actually quite good, especially technology. Tech companies normally have a lower debt and lower interest-bearing securities and so on. So there you have it. I hope you enjoyed the video. If you are enjoying this kind of content, please subscribe to the channel. Like I've said to you before, thank you so much for every single one of you for helping the channel. Like if you find it any useful, any of the videos, even if it's one video that I posted in the last 2 years, thank you. Okay, thank you for liking it. Thank you for sharing with your family and friends, and putting the word out there if you like. Have a wonderful day. Assalamu Alaikum.